Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. Today's episode is the next in our series of profiles of emerging investment firms. In these interviews, we dive deep into the various components of building an investment firm that can compound. Our guest on the show today is Greg Dean, the founder and lead investor of Toronto-based Langdon Equity Partners. Greg founded Langdon in 2021 after successful stints at Fidelity and Cambridge Global Asset Management. Langdon describes itself as an active and engaged owner of world-class smaller companies. The firm has assembled concentrated portfolios of companies with enterprise values between $500 million and $5 billion that are cash generative and are run by long-term oriented executives. In this conversation, we discuss why Greg wants the Langdon office to be more like a library than a train station, his definition of a compounder and the unique challenges of managing such companies within small cap strategies, how Langdon has tried to position itself differently from other small cap focused firms, the kinds of mistakes that prevent companies from realizing their full compounder potential, and the cultural elements that are most important when building a new investment firm. And without any further ado, here's my conversation with Greg Dean of Langdon Equity Partners. When we first spoke, you told me that instead of occupying the 17th floor of an office building, you rented out a two-story building that would house everyone. Can you talk about why you did that?
Yeah, I put a lot of thought into that. You know what? After 15 years of investing and then taking a year off of gardening leave, you spend a lot of time thinking about, okay, what is the environment that is going to help foster investment excellence? Because I think doing a bunch of things a little bit better is how you win long term. It's not sort of any one thing. And how you work and who's in the space, I thought was one of those sort of really important, underrated decisions. And so couple things. One was I knew, to deliver Hall of Fame returns, you can't think like everybody else. So it was critical we just relocate out of downtown, where a lot of that sort of commodity thinking existed and where brokers could come knock on your door or show you stuff just because you were nearby some other meeting. And then the other one was just ideally somewhere quiet, somewhere where you could do a lot of really good thinking and not necessarily act.
And along those lines, you also said you wanted your office to be more like a library versus a train station. What does that mean to you? And maybe, you expand that analogy a little bit.
Yeah, thinking about or even visualizing those two spaces, they're very different, right? So I felt like I grew up at the train station in this business, and I loved it at that stage of my career. Just companies, 10 companies in. Down at South Station in Boston. So I guess the literal train station. The Fidelity office in Boston was next door. And it was awesome. You could decide which meetings you wanted to attend. There were typically many meetings going on at any one time. But I think as you get into situations where you're making investment decisions as opposed to, purely conducting investment research, you get paid to think in this business and infrequently act. And I think the industry is sort of set up the opposite. The other stakeholders in the industry, they get paid to act. So they're always enticing you to act. And that often takes away the ability or the time that you have to think. And so the train station, there's no shortage of places where you can go or people that you can go there with. And pretty much everybody's selling you stuff, like I said. And all those things, I think, ultimately distract you on your investment journey. So the library is just somewhere where you can envision a lot of deep thinking. And that was, really important. We don't have Bloomberg on in the lobby, which is, I know, something we connected on in a previous conversation, stuff like that. We just try to make the environment conducive to the type of work that we think we get paid to do.
And before we hit record, we were talking about some of the people you worked with at Fidelity. I'd love to hear. I mean, there obviously there's a big contrast between what you're trying to set up at Langdon and a huge shop like Fidelity. But what are some of the beneficial things or the key learnings, the things that stick with you that you took away from Fidelity that you think can be helpful as you're plotting Langdon's course over the next decade?
Yeah, great question. A lot of things is the short answer. There aren't many firms in the world that 6 months out of school would hand you a credit card and a sticky note with, call it 10 tickers, and basically say, we don't need to see you again until, you have an opinion on these 10 businesses. And, take 6 months, take 3 months, but don't take a year, because by then we'll probably have brought somebody else on to do the work. So just the amount of I'll call it like autonomy and responsibility, but also like the amount of motivation that catalyzed for me, that there was nothing in my way except me and my ability to kind of build the relationships with these teams, get to see the assets. And if that was important to me, like, they don't really require you to do it one way. And often you're running a meeting. I was covering consumer and infrastructure, 15 years ago or so. And you'd have PMs joining the meeting, all who have totally different styles. And that was also really interesting, just to see all the different ways in which investment excellence can be delivered, and appreciating that there isn't one way. Nobody there was trying to have me do it their way or one way. And I was pretty open-minded and curious. So I feel like I picked up a lot of things. You'd have some people just kind of flipping through trade journals, every month. They got every single trade journal known to humankind. And that was, they never read sell-side research, and they just felt like they could spot trends and identify themes. And then you had other people who had, every cell was 9 decimal places in their model, and they ran these like very intense quantitative screens and analyses of businesses and the output. And so coming out of school with a math background, I feel like I've tried lots of different shoes on before ultimately deciding here at Langdon which ones I think are timeless and like I said earlier, just conducive to delivering that long-term investment excellence.
And I know another thing that you've thought a lot about was team building and creating a culture at Langdon that would last. And when we originally spoke, you mentioned to me that your seed investor, which is Pinnacle out of Australia, told you to get your year 5 team together today as opposed to in year 5. Why was that so important to you? And what does it say about how different Pinnacle is as a partner?
Well, I can tell you, after talking to a lot of different potential partners and also having just been a student of this industry for a long time, there aren't a lot of people like them or firms like them. Just their DNA is to take minority stakes at either at the seed stage or at the very early stages of a business that's scaling up. But it's critical that they back the team, they back the asset class, and then they back the vision for where that business ultimately longer term could go. In fact, for me, having really only had the opposite problem in my career, it was, go raise $1 billion and then we'll let you hire a junior person, or prove that you can deliver out performance by yourself, essentially, and then we'll allow your team to scale. Like, that's just not how business works. That's not how investing works. The idea that you would say to Apple, get 100 million in revenue from a product that doesn't exist yet, and then we'll let you hire the engineers and the salespeople to potentially build that product and scale and commercialize that product. Like, it's backwards. But for whatever reason in the investment business, it's not backwards. It's way more common to tell people to go find the revenue before you're allowed to bring on the expenses. And so I just wanted there to only be one reason we failed. If we failed, it was because of the returns and the service that we deliver for our clients. I didn't want it to be stuff outside of my control or stuff that I don't feel uniquely qualified to contribute to. And so we talk a lot before we invest in a company about how to break that company. What are the ways in which that company could be impaired? Langdon can really only become impaired if we fail to deliver on that promise of delivering exceptional returns and exceptional service. And I think a firm like Pinnacle is the critical stakeholder to make sure that we can stand by that claim.
That's really interesting. I mean, the chicken and the egg problem in investing is as you highlighted, and basically the inability to invest in R&D before you have revenue is really, I mean, it could be the reason that firms fail. So that's a really interesting take. So, this podcast is called Compounders, and everyone has a different definition of what a compounder is. And it's something that I've thought a lot about, and I know you've thought a lot about. How would you describe, a Langdon compounder to you, and what is, and has that evolved over time as you've moved from different investment firms?
Yeah, it's certainly evolved, and I think I have only a little bit to add to what I think are pretty commonplace definitions. Obviously high returns on invested capital, and high rates of invested capital growth. I think people often miss that second part. They're just super focused on the returns and neglect that the business may or may not be shrinking, or may not be investing sufficiently to sustain the rate of growth. So for us, it's actually a business that we can understand, that's able to scale both its human and financial capital at above average rates for decades. So I think the people side of that, again, is not uncommon, but it's not as common as people who squarely focus on the math.
And one problem with true compounders is that if you buy them with $1 billion market cap and it really works, they don't stay small caps for very long. And I think it's one of the issues of running smaller company focused strategies. So how in your history have you dealt with successful companies becoming too large for a small cap portfolio? Do you have specific sell discipline? Do you look for investor? Do you coach your investors that you're going to hold things for longer, even if they look optically too large for the strategy? How have you thought about that?
Yeah, we in order to kind of stay true to the art form of investing in smaller companies, we're not going to do what some have done in other asset classes, where they basically have just created these. You can think of, not to pick on venture, but in the last number of years before the world changed, there were some venture firms saying, "Oh, we're going to hold like very small stakes in public companies now because they're still great." But their job was Series A or seed or pre-seed, and that was sort of what they were hired to do on behalf of their clients. And so for us, we talk about a range of 500 million to 5 billion is sort of our time of first purchase, so our initial investment. And we don't want clients to one day look at their portfolio, their Langdon portfolio, and see a bunch of $25 billion companies. It'd be a champagne problem if that was the case, and if we bought them small enough. So part of what we have tried to do is make sure we identify them early enough, so that given the amount of work we're going to do up front, we don't want to benefit from a good back half 2023. We want to benefit from a good decade, a good half decade. So finding these businesses small enough, I think, is important, and we've set the research team here up in such a way that we think we have a good shot at doing that. But ultimately, you have to let them go at some point. It doesn't mean they're not going to go on to be great mid-cap businesses and eventual large-cap businesses. We have lots of situations like that. But I do think the way we work is much more conducive to diligencing smaller companies, and you have to decide early on how true to form you want to stay, versus diligencing $100 billion business versus a $500 million business. Like, I'm just not sure we're set up to do the second one, or the first one, very well.
And that's an interesting thread. What do you think is qualitatively or quantitatively different about the research process when you're looking at smaller companies? And then maybe you can just also discuss some of the hallmarks that you come across of these companies that you think have the potential to be much larger.
I think one, because I did, Fidelity was very much market cap weighted. You start with your large caps, and they're moving around so much money that it's essential that you get your large caps right. And many PMs there will say, "I don't care if you ever look at anything under $1 billion, because I probably can't buy it." So I've actually done the whole gamut of size, but part of this is just personal preference, personal bias. What are you curious about? How have you built your own blueprint for success? And a big one for me is people. And I think, like, the larger the company, the more likely that business is run by systems and processes, and people have far less ability to move the needle as a small group individually. And so, and that's by design. Like large organizations need to be set up in such a way that they're too big to fail, and that no one person can usurp the identity or the strategy or the reputation of that business. And that comes with it a different risk profile often than smaller companies. So I think the way we're set up and the type of work we do is we build relationships, not just with the asset. We build relationships, and again, not just with the CEO. If it's a sales-led business, then it's probably the top 25 people in the sales team. Or if it's a manufacturing business, we've seen 75% of their fixed PP&E wherever it is in the world. Like, part of why we needed a Pinnacle, because it's really expensive to do the type of diligence that we do. You're not just behind the computer waiting for annuals and quarterlies and giving them a good read and then making investment decisions. We're getting out there and building these relationships and seeing things for ourselves. One of the core principles here is trust but verify, and a piece of that is the only way you can verify at times is to have access. And I don't think all large companies are set up to give access to investors beyond the sort of like mega $1 trillion plus managers. I'm sure they have no shortage. Certainly at Fidelity, we had no shortage of anybody, anytime. We need you in the office, we're going to come to you. Crazy stories. But so that access, while valuable, is not necessarily impactful if you're not going to get any information that doesn't help you build your mosaic. So long answer, but I think that people matter more to smaller companies. And I think it's also nice when you can hire a company to do something, and then in 10 years, you still just need it to do what it's currently doing. You're not hiring it to be something different or to be in 6 other regions or to have some vastly different profile than it has today. And when you're dealing with $100 billion, $1 trillion companies, the law of large numbers becomes a huge impediment to being able to just hire that business to take its market share from 4% of LTL trucking to 14%, not from 61%, and then the DOJ gets involved if it gets above 70. That's a different game.
Yes, you're preaching to the small mid cap choir here, as this has been the focus of my career, and I share a lot of those sentiments. And so we've talked about some of the elements that you look for in successful companies. What about the opposite? My guess is you've come across a lot of smaller companies in your career that you initially thought had a chance to be compounders, but something got in the way. So what are some of those things that you think have prevented certain companies from reaching their full potential? And I think this is kind of almost like a uniquely small company problem that that you always have to, when you're looking at smaller companies, you have to be really relatively cognizant of.
Yeah, and it's certainly for me. When I started in this business, I was younger than most executives had years of experience in their company. So, I'd leave a meeting being like, okay, they've been CEO for 27 years and I'm 26 years old, and so just having sort of the courage to ask the hard question or to say, I don't understand what that means. Can you explain it to me again? And in that process, one of the things I came to realize is first of all, decision making at a company is still very much human behavior, human biases. Like, there's a lot of psychology that you can apply to making investment decisions and business decisions. And I think a common one that kind of catches people on their journey towards success is short-term thinking or short-term gratification. A lot of these people, these potentially very talented individuals, they see a corner or a shortcut, or somebody tells them this is the faster way, the better way, and they outsource a bunch of the decision making or the thinking to someone that they trust, but maybe someone that they shouldn't have trusted. So it could be overpaying for an acquisition, hiring a management consultant to tell you the answer when really they don't know the answer, but they're paid to give an answer. And I think beyond short-term thinking, short-term gratification, just management teams that are unwilling or unable to do the hard thing. Saying no when everybody else is saying yes, that's really hard. And sometimes saying yes when everybody else is saying no is really hard. So what I've seen more often than not with these smaller companies, and this is why we diligence the asset separate from the people, could be a great business with all the characteristics you'd want in a long-term compounder, but is that the right team? Do they have the humility, the work ethic, the experience, the knowledge, and also just like, is the structure, common question in every one of our first meetings is, how are your people organized? It's a pretty dumb question by traditional standards, but we learn so much about that question and how the business is set up. Is it the CEO with 6 direct reports, and each of those 6 direct reports are one of the key functions within the business? And are they regionally allocated? Are they set up in one major HQ? How long have they been there? Where did they come from? Like, just, we map it out. Like, the org chart is a nice slide, but we bring it to life. Typically it takes, more than the first meeting just to get that understanding. And what we're trying to do is make sure that the people and the structure are set up to not get in the way of the ability of that business has to compound.
And I guess, in addition to what you're told by management, which you should always be somewhat skeptical of, I think, as an investor, what other outlets have you found to do true diligence on people that you're never going to know 100%, but gives you some comfort that these people have the right North Star, they have the right skill set, they understand capital allocation? What other avenues do you typically pursue to be able to get comfortable with those elements?
It's a mosaic. It's a many, I'd love to say it's A, B, or C. A big one that I think has emerged quite frequently in our toolkit is LinkedIn. Whether or not you actually reach out to these people, you can actually start to see, I'm ex Danaher, I'm ex Boeing, I'm ex Coca-Cola, or Procter and Gamble if it's a consumer business. What does that actually mean? Does it mean you were there for 7 months in a like a quasi apprenticeship role? Did you have a P&L that you were responsible for? Did you have 200 direct reports? Like, what did you actually do? So now, we'll ask them, they'll give us an answer, we can go away and figure stuff out. And that has been, ideally we even get former employees, common connections, where we're able to say, what was like working for this person? How well do you know this person? What sort of leader were they? And so, we're seeing this more and more because actually COVID has catalyzed a ton of management turnover. So people who just said, my priorities have changed, or I want to be closer to home, I don't want to be traveling, like tons of different reasons. And now with all these new management teams, sort of people moving around, you wake up one day and you're like, oh, I knew that person from this other place, or they also sit on the board of this other business in Germany or in France or the UK, whatever. And we're able to kind of just follow these threads, and we're not in a rush. So sometimes it can take months to get real valuable insight. But that's one tool that I think has increasingly been helpful, to just map out a lot of these structures and validate that, there was actual impact had at some of these places, and not just, a logo on a resume. Another one that I think has been important is, we are known for asking like some pretty different and direct questions in our meetings. So, and to be honest, I had listened to a few episodes of this podcast because there's overlap with some of the companies that you'd interviewed, and management teams that we admired and owned at different points. And they'll all say, those guys are very direct and very well prepared. So we often, early on when getting to know business, we don't like to ask questions we don't already know the answer to. We're interested in how you answer it. We know what you're going to say, but the follow-up is critical, and the follow-up to the follow-up, and then trying to catch you in a situation that maybe makes you a little uncomfortable. How do you address it then? Is it the same as you addressed it when you were on CNBC and we're totally in sales mode? Or did it sound different? Or in 2017, when you first said that thing, how similar is it to what you're saying now? I think just having a deep data set and the experience in that asset class for a number of years it becomes a weapon over time as well.
Yes. I mean, I think it couldn't agree more in terms of the differentiation, or the differentiated way that you can get information out of people, and like how valuable meetings can be if you ask the right questions, right? And that's, I think it takes a long time to figure that out as an investor, and this venue, the podcast, is actually a good way of doing that, because I start to be much more granular and not ask questions that are easily answered with a boilerplate canned response. And that's, as you know, challenging, right? Because a lot of people are really well coached. Um, so the whole world of compounders, kind of got really hyped up in 2021, and hashtag never sell became very popular on Twitter and even in the financial press. So we talked a little bit about your sell discipline. I mean, you're not going to have a $25 billion stock in small cap, but what other kind of things cause you to sell a company that you've already deemed a compounder, or that you previously deemed a compounder, and that you like, but don't think has a place in the portfolio anymore?
Yeah, I mean, the best reason to sell is it's too big. That's like I said, a high class problem, but there's way more uncomfortable reasons too. Sometimes you're just wrong. You either got the thesis wrong, or you rated the management team too highly, or significant turnover in the management team causes you to question if the business is as you see it. Because at the end of the day, we don't work there. We're not on the board. We have to respect the fact that we're getting a piece of what's true, and we're doing our very best to build a rich mosaic of truth, but it isn't like indisputably true. And the financials, I think often, and this is where some of our questions come from, the adage of like Warren Buffett will say, start at the back of any release or report, or start at the bottom. Just doing that consistently over time, you start to learn what are some of the ways in which I can validate if this person is, true to form, or if they're constantly telling me the best of what's possible in the future. And so, if we're wrong and we don't have the conviction necessary to sustain that investment, like, it isn't all our money. So the responsibility to make decisions and act with, integrity, but also intellectual honesty is sort of top of mind for all of us. And if there's a gap in between like your perception and the reality, we try to aggressively or very tenaciously dig into that to figure out in a matter of days, what side are we ultimately going to fall on, and then make the decision necessary. So we'll sell because we were wrong. Sometimes we'll sell because we trust a lot of what they're saying, but we can't verify it. There's just some businesses, and ideally we're not going to invest in these types of businesses, but sometimes you find yourself in a situation where, you business models shift, or regions that they enter evolve, and now you can't get the good industry data necessary to validate. Like, every management team is going to tell you they're going to grow 8 to 10%. 8 to 10% top line with some margin expansion and maybe a share buyback, and we're going to deliver 10 to 15. And it's like, okay, what's the industry growing? And no business has one industry that they serve or one region. So it's not in a vacuum that easy to track down. And so, often we're trying to find rich sources of data that are independent of the management team giving us that information. And if we find an industry that long term, which to us is like 10, 20, 30 years, is growing 4%, and this management team says, oh, we're going to continue to grow 12%. Okay, how long can you do that for? We can do that for a long, long time. And we just do the simple math, and we're like, okay, so you'll be 92% of the industry in 12 years. How's that? Do you think that's possible? And you get the look of like, well, maybe we'll have to look at new countries, or we'll have to, start targeting customers that are smaller than our enterprise customers that we've historically had success with. And so it's like, oh, okay, so you're going to have to be an SMB software provider at some point. Let's go down that conversation thread. But when we see those sorts of situations where we're going to ultimately end up having to hire the business to do something they've never done before, and we find ourselves maybe there after we bought it, we'll have to sell if we can't verify or validate that that's going to be a good use of shareholder capital. And then sometimes access is just not great. So management teams typically make themselves really available when the news is great, and then when the news isn't so great, you just can't get them. And we'll do anything. So like, if we have to fly to your house, or we have to meet at some middle location, like, there's not really a good reason for us to not be able to get to sit with you and to sit with your team. But if we've tried now for a number of months and the reasons just keep growing and growing and growing, like, oh, I'm in Toronto, but we don't want to start the day that early. Oh, you're in London, but actually I'm going to be out of town that week. And if this goes on for a period of time, often that causes us to start to question, like, why are they not available? They were very available at a 52-week high, and here we are. So Stuff like that can often impact the decision to sell as well.
And you talk about being direct and asking, kind of differentiated questions. In my experience, there is some benefit to helping your companies as an investor. And I'm not saying necessarily through activism, but maybe some suggestivism, which is kind of how I would consider myself. Where does that fit in terms of the Langdon structure and strategy? Are you behind the scenes talking about corporate governance and capital allocation and compensation, or is that not necessarily part of your DNA?
No, I mean, we define ourselves as very active and engaged owners of world-class smaller companies. That's what we stand for. And so, but it's very deliberately not activism. We are not interested in investing in a company that isn't well run, or with a management team that we don't admire and respect, or think in all likelihood will do a fantastic job for our clients. Doesn't mean we don't find ourselves in those situations over time. So I think your point about adding value to management teams is a really underrated one, because often why we have the access and the relationships that we do is because they know when they meet with us, they're going to learn something. And that's not coming from a place of ego. It's coming from a place of preparation and the fact that we have a global lens. And most of these companies only operate in their country, or only operate on their continent. I've never met, like, we own a business in Denmark that's a large multi-beverage manufacturer, large by our standards, $4 billion. They're not sitting with Heineken. They're not sitting with ABI. They can't go meet Carlsberg. We do, because we want to understand the industry. And the business that we own is such a small piece of that industry. We have to go meet those other players to understand how the whole industry is functioning. And so when we come back and say, hey, we've met Heineken 25 times in 15 years, that's the most positive they've ever been on industry pricing. They go, oh, interesting. Did they give any sort of regional, conveyance there, or was it just sort of like a broad statement? And who did you meet? Was it IR? Was it CEO? Was it, COO? And so we do think of building relationships sort of like as a give and take. And ultimately, you're not going to, like in most people's personal lives, if you have people in your life that only take, you don't have as much time for them. So we both give and take in those relationships. And we only own 27 companies, so it's not like we're out there trying to build relationships with 1,000 different firms. So it's not that hard to actually have value to add to that small group of management teams that we respect. And then I think that ultimately ends up being one of the ways in which we can add value, because you just get more out of people who feel like you prepared for that conversation or for that interaction. They have more time for you.
Yeah, unfortunately, I think a lot of our brethren in the industry don't spend enough time before meetings, and so there's a very low bar for us to jump over in a sad way.
Well, look, I was in Manchester last week, £7 billion business. I don't know if I should say their name because I would be outing their investor relations team, but they said since COVID has ended, we were the 5th investor to come visit them. FTSE 100 or 150, probably been a business that's been public for 7 years. It's maybe tripled in 7 years. It has 95% market share. It's an online auto marketplace business. And to hear that, 5 is wild. But that speaks to, they're probably super available on Zoom. They also are a pretty large dominant monopoly. So you look at the numbers and you say, oh, I'm buying the numbers. I don't really need to go diligence the team, understand the working environment. But, all of their customers are in the UK too. So if you're not going over to meet them, you're probably not doing any customer analysis either, which ultimately is we think, a gap in the knowledge.
Sure. And moving into kind of philosophy and how you've evolved as an investor, I love the idea that a stock can be a mentor for people. So are there any companies that you've invested in during your career that taught you lessons about the power of compounding that you'll never forget, and maybe have even informed your investing style as you're building Langdon?
Yeah, one of those lessons that I think about every day is, bad news needs to travel faster than good news. It just has to. And so whether it's your own business, now that I'm obviously heavily involved in building this business, what do you think I said to every single person on the team in every department? Doesn't mean we're going to like to have that conversation, or we might not like what the result was, but it's important that we're all across that information as real time as we can. And so that's kind of where, so that business is a very large IT outsourcing business, which initially started here in Canada, a company called CGI, but is now very global. And they had every regional VP of every single business line sit in front of each other on a quarterly basis, presenting on the same 6 KPIs. And I think it's one of the first businesses that I ever looked at as well, that we had to distinguish between being an owner and an ownership mentality, because that business really only had like 2 large employee owners, the CEO and the chairman, but something like 48,000 of the 52,000 employees were owners. And so, and if all that matters is their ownership interest in that business is really material to them. It doesn't need to be material to the shareholder registry for the right behaviors to be incentivized and the right decision-making architecture to be in place. And so, just as we got to understand this business and realize, like, there's probably not going to be much that happens in their industry that they're not across on immediately. And they've set up an environment and a culture where they are very open and respectful of bad news, and willing to take bad news and use it as a motivation and not as a shaming tool, in such a way that bad news is kind of hidden and kept below the radar. And so shockingly, they've become a very agile business that can go acquire other people's problems and fix them. And typically when you're an acquisitive business and you're buying underperforming companies, you're typically paying much lower entry multiples, but you better have that DNA to fix these companies. And they've now been doing that. They started only in Quebec, and then they went Quebec to Ontario, and then they went Canada to the US, and then North America to Europe, and Europe to Asia. So they have proven that the model scales. But I think what was critical in that situation was they needed the decision-making architecture to scale as well. And so, earlier on when I mentioned the human capital needs to scale, it's really hard to build a 50,000 person organization that thinks like it did when it was 50 people. Like, really hard. And not that many companies are going to be successful doing that. And so part of our job is to figure out which ones will and which ones won't.
And going along that theme a little bit, I like the idea of what is a quintessential Langdon stock that embodies almost all of the elements that you look for. Obviously this is a podcast where we're not going to go deep into individual ideas, but I love an example of, like, what's something that you own now that you think embodies everything that you look for in a business and a management team.
Well, Royal Unibrew in Denmark would be one. It's a management team that has been there for a long time. So often, like in the investing world, if you take PMX and you put them on track record Y, and then you go to sell them into market Z, it's like, I don't know what I'm buying. Like, is it this person's approach? Is it the historical pool of capital? Like, and we struggle with that too. If it's like this, world-class individual or team, but they're jumping onto this other asset, but you can't go audit the historical output of the asset in conjunction with the team, that can be difficult. So, in Unibrew's case, management tenure has been pretty long. Board tenure has been sufficiently long. We don't like to see it too long, but sufficiently long that you can actually audit the track record. We talk about, value investors want to look at the last 10 years. Growth investors want to look at the next 10 years. And we're like in between, where we want to look at the last 5 and probably the next 5. And so a business like Unibrew allows us to do that. They're in a number of different markets. They're in both carbonated soft drink, alcohol, juice, water, and also Nordics, Italy, Baltics. They've just actually made an acquisition here in Canada of a brewer, which was interesting, and not to digress, but their thesis there was, we used to charge a premium for imported on the bottle. This is sort of like pre, the craft explosion. But now the price points commanded by a lot of these local craft players are the same as the importeds, if not higher. Why are we shipping water on water? Why don't we localize our production much closer to our customer base, which is going to save on freight, logistics, and in a lot of cases, energy costs as well, because North America has structurally lower costs of supply of energy, which is a big input into, brewing as well as glass manufacturing, where a lot of these beers are consumed in. So they're just as operationally focused as you could want from a management team. Like, they're not sitting behind their spreadsheets trying to run their business. They're out in the field. The decision making is very decentralized. Every region has its own senior leader. They meet frequently. Best practices are shared, but they are not sort of mandated. And really, what they've tried to do is take admin out of the field, but not autonomy and decision making. And I think that's a delicate balance. It sounds like a great soundbite, but we've seen companies go too far in both directions, like leaving all the responsibility into the field, and then the headquarters gets the numbers at the end of the quarter, and they're like, "Oh my goodness, we're going to have to guide down because we didn't know things were going that poorly." And vice versa, the command and control from the center is also not a great fit. So we're very open-minded investors, but I think that is a compounded invested capital north of 10% for 10 years at a very high return on invested capital. So their ROICs today would be a little bit lower than they were, call it 5-6 years ago, because of some acquisitions that they've made. But when you can earn a 20 ROIC on $1 billion, it's a pretty powerful compounder from that 20 ROIC on $100 million. Like, those are the real exceptional businesses, is like the sneaky rate of invested capital growth with no decay on the return on that invested capital. Those have been the ones that have been the magic compounders that are in industries that we can understand quite easily.
Interesting. And getting back to the culture question, which was where we started a little bit when we are talking about where you're situated and the kind of investment ambiance that you like to create. You've been involved in building some highly successful investment management firms in the past. So I'm interested in what firm level and cultural elements you think are required to build a business that compounds within the investment management industry.
I don't think any question has probably kept me up more in the last 3 or 4 years than that, because no one will I think it's very hard for people to build anything of significance alone. So by definition, you need a great team, a great group of capable people who all are going to have to leave great jobs with tons of upside and upward mobility, who love their boss and are paid really well. And so to create that environment is one thing, but then you need to sustain that environment over long periods of time, because to compound an investment business over long periods of time requires a lot of people, and also a lot of experience and a lot of time spent working together. And I think one of the things that I think has helped is I've over the couple firms that I've worked at, I was always very involved in recruiting. And I think early on, like a lot of people, you make some very obvious in hindsight mistakes. Like, you want to hire yourself, right? Like, oh, somebody who's like this and like this and like this, and came from there. And then you go, oh man, that didn't work. And even worse is you maybe manage other people or work with other people the way you would want other people to work with you, which also is not great. So it's almost like you and this is sort of how I found myself in the investment business, is I tried 15 things and found out I didn't like them. And then this was the first thing that I tried, and I went, okay, I think I could, spend my whole career at this and still feel like I have a lot to learn. That was very interesting and motivating. And so when it comes to scaling talent and developing talent and working with talent, being open-minded but also decisive is a really delicate balance. Like, you can't be willing to be open-minded on everything, or else nothing gets done. And if you are very closed-minded, I think you don't get the right type of people to work with you. So for me personally, I've wanted to surround myself with people who are inspiring and who inspire me, and people who ultimately I think are going to make me better. And so I took that view when I graduated, and I said, I'm going to go join this huge firm in Boston, when I had an offer from a much smaller entrepreneurial hedge fund. And their pitch to me was, you'll be making decisions here right away, because we're not very big and you're going to be instrumental in our success. And weirdly, I found myself saying, like, I don't know anything. I don't know if I trust myself to make decisions. I don't know if you should want me to be contributing to the output of this firm right now. And so I want to go somewhere where I can just be a sponge. And in my mind, I think at that time, I thought, okay, I'll be a sponge for some period of time, and then I'll be able to offer people a lot. And I find myself still in sponge mode. And so collecting a group of people who are also still in sponge mode at different stages of their career, who all, one of the things we talk about is slope versus elevation. You can hire somebody at a very high point of elevation, but if their slope isn't sufficiently high, they're going to get lapped, certainly here. So we want people with a very high slope, people who are super curious and passionate about investing, and then people who ultimately want to work collaboratively. I think one of the things we've done really well is we've institutionalized collaboration. So, at least two, usually three people will look at a business before we invest. So it's not by committee, but it's also not an individual sport. And I think that I've been part of teams where you go and you do 6 months of work and then you come pitch it to the investment committee and it's like everybody against you. And that's their job, is to push back and say no and ask hard questions. But that's not really going to create the right environment for people to want to support each other and help make each other better. So what we've done is said, okay, you lead this region. So if it's a business in the UK, it's Joel. You take care of that. But since it's a software business, Mansoor is going to be involved alongside you. All the management meetings, all the access with the asset, any sort of customer work, supplier work, that sort of thing. If the two of you think it's super compelling, then we'll talk. And if the three of us are all on side, then we have a good chance at making an investment. So, the investment team here is 5. I'm not sure. I'd like it to stay as close to what it is today in a world in the future where it's much larger than 5, but it's hard to say. You're making these decisions day by day, person by person. But I will tell you that it's hard to study this industry, the success cases, because they're all private. Like you can go study every public firm and there's been some issue, some challenge, some cultural hijacking that's gone on over the career arc of that firm to the point today where it's not recognizable compared to what it was when it, was early on. So we're trying to learn both what not to do, but also adopt some best practices that we've all encountered at firms that we've worked at previously.
And where my mind goes as I listen to your response goes to retention. And so, the typical path for someone is they're an analyst and then they eventually want to become a PM. But there's this reality that there are only so many portfolio manager roles available at any firm or in the entire industry. How have you thought about keeping people engaged and contributing, even if there's not an obvious promotion path or PM path in front of them?
Yeah, I think one important one, which is at the cultural fit stage, is how do you want to win? Do you want to win individually or do you want to win as a team? And just conveying, and because I've played this investment sport as an individual, and I've also been a part of some really high caliber teams, and then I've been on a team where everybody was an individual, and so you see all these different ways, and it just became very clear to me that we all need to be like one firm P&L. Everybody here is an owner. Let's make sure that is just table stakes and clear out of the gate. We're trying to build terminal value in this business. We're not trying to be well compensated along the way. So culturally, just finding people who can want to get better, want to work with people and respect each other who they think make them better, and are willing to kind of always look at themselves first. So I think one of the things, to answer your question, we don't have analysts and PMs here. We have investors and lead investors, because separating the analyst from the PM, it's like, okay, you do some of the low value work and then I'll make the decision. And that's sort of how I see that framework of, you're the analyst analyzing the information and then I'll make a decision with your information. We have investors here who are both, we call it tasked to make us smart, but also make us money. Everybody here has the responsibility of both, but depending on where they're at in their career, you can still have a really fantastic career progression here if you're still in the make us smart stage. It's really hard to make people in the investment business smart. Like, you can go distill information very quickly in today's age. It's information is essentially a commodity. It's what you do with that information that adds value. So everybody is responsible to make us smart and make us money. I think the difference is lead investors have a track record of being able to make investment decisions that add value above, all other opportunities. So Some people may be exceptional at making us smart, but may not have that proven ability to make us money. There's still a fantastic future for them here. So, and they're very involved in all aspects of the investment diligence as well as the investment decision making.
And a lot of your philosophies and the cultural things are important too, and the way you speak, speak to a differentiated way of thinking. And as I think about the path of someone who's starting a firm in the last couple of years and trying to compete in a very crowded space, I'm interested in about like how you've thought to differentiate yourself within the world of small caps, international small cap, whatever the competitive set that you're looking at, and with that and within that is the obvious question of allocators. How do you differentiate yourself within the allocator community? When I say the word differentiation, where does that take you, and what has been the strategy to try to do that as you've been building Langdon?
To be honest, I think it's a byproduct of our approach. Like, I'm not sure we would tell you that we're different or tell you, specifically how we're different. I can tell you some of the things that we think are critical to our success, and then I think the feedback we get from allocators is, where are the aspects that are unique and different, and that they aren't finding that common among our peers. And certainly we study a number of very successful firms who do what we do. I think first and foremost, being independent and investment led narrows the field. It doesn't shrink it to only success, but just you've eliminated, I think, some of the real issues around principal agent in our industry that can cause long-term pain for allocators and for clients. Another one is, the fact that, and this is one that I probably didn't appreciate was as misunderstood as it is, but when people with experience go to do something from scratch, it's almost like the industry is set up not to support them. A lot of big firms, a lot of big, plans will say, you need 3 years and $500 million and a team of 10 that's never had any turnover, and then give us a call. It's like, okay, that isn't necessarily going to mean you're an early adopter of any of these, newer firms. And I think we distinguish between new firms and new investment talent, because I think that's an important one. You need experience, but you may not have experience at the name above the door that you're currently at. So I think that's one aspect. Sorry, I forget the question.
Oh, just differentiation, and how do you position yourself, right? Like, people see so many different pitches, and we're long term. We care about price. We're concentrated. Like, you walk around the streets of Omaha, and during the Berkshire meeting, and you run into a lot of people who look a lot like yourself. And so I've just started to think about, how do you, especially as you're starting a new firm, how do you position yourself to be successful, given that the ideas that you are espousing are nuanced but not necessarily proprietary?
Yeah. The two that we sort of knew were necessary preconditions to even attempting were people and structure. Because I think if you get those foundational principles approximately correct or really correct, ideally, you're going to have a much better chance of being successful. And so I think that's where we talked about Pinnacle. We talked about the group of people that we've assembled as critical to our long-term success. In terms of the investment decision-making itself, we've tried to skew the odds in our favor a couple ways. One is focus on industries that we think companies largely control their own destiny. So, 80, 90% of our clients' capital is in consumer, industrials, financials, and software. And just not trying to be all things to all people. Doesn't mean there aren't great companies in these other sectors, but it's an enormous universe, and let's narrow the focus to something more manageable. But by design, we don't screen based on quantitative output. We don't have ROICs above X and growth rates above Y. And I think if you do that, you're just narrowing the field of play at any given moment to a subset of companies that might fit that criteria for a bunch of reasons that make sense, but a bunch of reasons that don't make sense. And my favorite one is always a great long-term track record that has made a large acquisition such that the returns on capital have gone from 30% to 10%. But they have a real credible plan and a team to deliver incrementals to get them back to that 30. But since you wanted above 12, you never found that company, or you found it at the wrong time. So what we did there, which again, universally the allocator client community has told us we're nuts, is we just met all of them. We spent at least an hour on over 5,000 companies in almost 8 years, because we just said, why don't we just meet them all? And it might seem hard, and it might make for a very busy next little while, but if we truly are doing this for a long time, everyone on the investment team is in their 30s still. What's 6 years? Then we'll have a data set of over 5,000 companies, and we know what we thought about them at the time that we met them, why we maybe moved them forward, why we didn't. And so I think it goes back to that point I made earlier about unwilling to do the hard things. It wasn't easy. It wasn't like it was mentally taxing. It was just time intensive. And so, we've done that and not tried to rely on we've not outsourced the IP to Bloomberg or FactSet in terms of like how we shrink the world to our manageable list of 250 companies. And I think you can only do that with a certain type of group, people who are just wired and curious about businesses and people and investing. And I think, those would be some of the reasons that I think have led to our ability to outperform.
And it's interesting you talk about decision making. You basically employ a team tackle in terms of some of your ideas. How else have you tried to mitigate the inevitable behavioral biases that come in when you're making decisions under uncertainty? Any other things that you are cognizant of from your history, or as you were designing the process and philosophy, that speak to just the inevitable kind of human foibles that really can prevent you from being successful?
Yeah, I think by trying our very best to not be futurists, and just making sure that everybody knows it's okay to walk out of a meeting and go, I don't know what they do. I don't understand that. I don't get that, explanation, or it's the third time I've met them and I'm still unclear, why their customers sign with them. Like, just some sort of like sufficient level of humility to be able to just say, like, whether you call it a too hard bucket, or there's not this like, egotistical arm wrestle required of like, oh, you're not smart. You don't know this, you don't know that. I think that's a bit of a fool's errand in investing when you embrace, and maybe this is unique to smaller companies, but it's such a big pond. So part of the reason we spent at least an hour on all those 5,000 is because you'd be shocked how little information we could gather in an hour in some of those cases. So why are we going to go commission 3 months of work if in an hour we couldn't really figure much out that was helpful? That's its own tool to help guide incremental return on time, which in investing is as important, if not, maybe second to return on capital. So we think about both of those things, and I think that's been, pretty helpful in getting to this point.
And I'm interested in that, as you're whittling down that list. Like, how does that work? You whatever, you toss, I don't know, 60% immediately, and then there's 40% remaining, and then you have tranches, and then at a certain point you do a deep dive. Like, how does that work, and what does that data set look like now that you've whittled it down?
Yeah, you just one day realize that, like, hey, we're gonna get there. It felt like this, initially, to be honest, it felt like busy work for interns. That's how it kind of was conceived. It was like, oh, well, we have 2 interns every semester, and we want them engaged in investment work. We don't want them going to do things that are not helpful. Why don't we get them started on that? And then it was it was right after that we realized, like, A, they're not the right people to be filling out these, this template, and B, the value in filling out the template is super high. So let's maybe work with them on that. And so it really was one at a time, and then all of a sudden you're more than halfway done, and then you're 3/4, and then it feels like you're there. And now what we do every quarter is we rerun the same 23 countries, market cap restriction, liquidity restriction, and sectors. And we just look at what's net new. What have we not looked at that is there today that hasn't been there historically? We compare it to the database that is in place. And in terms of what we decide to move forward, we think of our funnel as extremely broad top of funnel within those core regions and core sectors, but then extremely discerning on what to move forward. Because if you knew in advance that something's going to take you like 1 to 6 months, that's a pretty high opportunity cost when you're a investment team of 5. So, but everybody here understands, like, no one's measured on velocity of output. It's quality of output. The strategies are structured that way. 27 holdings, 5 individuals, bringing 2 ideas in 2023 that could be, very, very meaningful is all that's required. So think about every January, I've got to find 2 great ideas this year. Like, it's a very freeing place to start. And I think that allows for the resource intensity required to make these great long-term investment decisions. And I think going back to your earlier question on how do we make sure people are working together, is everybody is an owner of the business, but also an owner of the product. So if we are underweight the US and overweight Europe, we don't have a US lead who's going, oh man, well, I'm not going to last very long at this place. Like, he's going, oh, I agree. I think that incremental opportunity in France is way more interesting than the last business that I brought forward. It's not on anyone individually. We have everybody working across each other's ideas. We travel to different parts of the world together. This year we all did New York. Last year we all did the Nordics, Sweden, Norway, and Denmark. So we're taking meetings together in different parts of the world to make sure that we all have like a common understanding of what good looks like. And I think that really helps people advocate for the best ideas and not necessarily their own ideas.
And it sounds like you've developed a very strong foundation where it's the philosophy, the process, the team building aspect, and obviously having a partner backing you is helpful as well. So as you look out over the next, call it 7 years, I don't know if that's quite long enough for your time horizon, but let's just call it 7 to 10 years. What would you like Langdon to look like? And what does success look like to you?
Yeah, success is, Hall of Fame returns and world-class service. And I know on a very limited set of products, like the products that we launched out of the gate are 2, strategies where I have, 10 and 7 years of historical experience to say, like, I'm pretty confident that these are great asset classes that if we're successful and capable, we will harvest, very strong returns for our clients. But B, they're also like very durable asset classes where we aren't like offering some sort of single point solution to a client that, they're going to need to trade around us because we're good in, when we've got a full moon and we're not so good, every third Wednesday. I think our historical reputation was one of just being all weather. And some of the things that people would say over the years would be, your portfolio is very eclectic, or I've never heard of any of these companies. And we take those as terms of endearment. And, deliberately, we would point out to clients or potential clients, like, there are stocks in our portfolio that are 10 times earnings, and there are stocks that are 10 times sales. So we do not care if, we have a 2022 or a 2021 or a 2023 or a 2008. Like, our job is to deliver investment outperformance over a reasonable time frame without taking on too much risk. And we will diversify certain risks away, but what we cannot diversify away is the idiosyncratic risk in the individual companies that we own. So if we select them carefully, we can mitigate some of that risk, but we can't diversify it to zero. And personally, and as a team, we're wired to see volatility as opportunity. And so it's interesting to me that every time we go through a period that we're in right now, the whole world gravitates back to public markets. A year or two ago, it was like, how quickly could I diversify my portfolio away from public markets? Public markets are like, the stuff that our parents bought. But now it's all about alternatives and private credit, private real estate, venture capital, you name it. And where are those people now making investments? Public markets. So the fact that we can offer daily liquidity, price certainty, and transparency are actual long-term, I think, beneficial guardrails for end clients that are timeless. People don't know when they're going to get divorced. People don't know when they're going to find that perfect house. If you have 12-year lockups or 2-year lockups, like there are definite benefits, don't get me wrong, but there are also significant drawbacks. And I think anyways, I'm off on a tangent, but as any asset class matures, you just want to make sure both the good and the bad are well understood. And I think the way we've set up Langdon is such that in 7 years, we hopefully have delivered on our value proposition of these two strategies and have earned the rights from clients to potentially launch and offer other strategies that fit within that mid cap to micro cap, framework where our research approach and research process give us unique advantage to harvest outsized returns.
And you talk about creating a product that's durable and kind of all weather, and I do love that compliment. Like we've never heard of these companies. To me, that's exactly what you want to hear from your investors. But in terms of the opportunity set that you see in front of you to outperform, to find unique companies, like what do you think is most underappreciated about that the set of companies and that universe that you've identified to go after at Langdon?
Well, I think I'll start with us as individuals because I think they're both important. I think the first thing is, having experience in hard times is critical because I think, and I still say this, coming into the investment world professionally, basically in the middle of the financial crisis, was super instructive because I think for the previous 8 years, it was all about the income statement. People didn't care about the balance sheet. And I walked into investing and it was like balance sheet, balance sheet, balance sheet, balance sheet. And then maybe 2 years later, it was, some mix of income statement, balance sheet, and cash flow statement. But for those people who maybe got, brought into the industry at the wrong time or were mentored by people who had made their careers only focusing on the income statement, that left tail event occurs and all of a sudden it's like, it's a career ender, it's a firm ender. So, coming in squarely focused on what could go wrong still benefits me today. And I think benefits our team. And so we look for companies that have that muscle memory too. We don't really care how well you did when times were great. We're super laser focused on understanding how your business performed when your end market was terrible or when cost of capital was high. And so the environment that we're in today is great because it allows us to test much more real time. We don't have to go back to 2001 or 1994. We can go back to last year. We can go back to last October and say, what did you do when freight rates went 10x from Europe to Asia and, glass prices tripled and energy prices were 10x and, how did it go? How did it work? And even better than asking, we were there. We were on the ground, asking them questions, seeing their, reactions to stuff. And so highly unlikely we're going to put money with a team that isn't tested or in a business model that isn't proven. Just not what we think our clients hire us to do. So I think this investment landscape favors people who are good at like true primary research and have relationships and access to actually go leverage those things to determine what's really happening, because I don't think the newspapers or the internet are necessarily responsible for truth telling. So you'll hear some sort of headline that, luxury watch sales are at, are down 26% year over year. It's like, yeah, well, last quarter, they're flat with last quarter. So like things aren't getting worse. They're just lower than they were in the free money era. And so the narrative around some of these data points totally misconstrues the reality of the situation. So when we can go walk into 7 stores in 3 countries and see how busy they are, that gives us a nice counterpoint to some sort of like Bloomberg automation headline that was grabbed as some economic data came out. And so, I think this is sort of the perfect setup for us. It's a lot of volatility, very high cost of capital, very high cost of failure, and a big cohort of management teams that have never been in this environment before. So, the delta between the haves and the have-nots is super wide. And that, I think, plays to our strengths of trying to invest in resilient companies, avoid leverage, and focus on cash returns on invested capital. People I think, will quickly forget adjusted EBITDA, but for most of the last 10 years, it was all that mattered.
Yes, as we all would hope that the number of adjustments that we all have to wade through disappears over time if people focus on cash. Greg, this has been incredible. I think you've built in a very interesting structure and foundation at Langdon, and we're going to be watching carefully as you try to hit those Hall of Fame returns. So thanks for being on Compounders, and we appreciate your time.
Thanks, Ben. As a first-time listener, and now ultimately someone who's been listening for many years, I appreciate it.
Thank you.